I want you to look away from the price chart for a moment. The price chart is flashy. It screams for attention. Seeing silver close the week at $79.91 feels historic. It represents a gain of nearly 6% in a single trading session. It puts us within 9 cents of that psychological barrier at $80. But the price is just the symptom. The real disease is festering in the vaults. While the world was celebrating those green candles on Friday afternoon, the CME group released a document that tells a much darker, much more urgent story. It's called the Daily Metal Depository Statistics Report. And what it reveals is not a rally. It's a run on the bank. I have the data right here in front of me. On Friday, January 9th, while traders were clicking buy buttons on paper contracts, someone else was backing up armored trucks to warehouses in New York and Delaware. In a single 24-hour period, we witnessed 2.7 million ounces of physical silver withdrawn from COMEX depositories. This is not an accounting adjustment. This is not a ledger entry. Withdrawn means the metal physically left the building. It means bars were loaded onto pallets, secured in trucks, and driven away from the exchange. Those ounces are gone from the system. In this comprehensive forensic investigation, we're going to audit this report line by line. We're going to examine the specific vaults that were raided, places like Asahi, Brinks, and CNT. We're going to explain why over 1 million ounces suddenly disappeared from the registered category at Asahi, removing it from available supply, potentially forever. And we're going to connect this physical drain to the massive $3.45 arbitrage gap that has opened up between New York and Shanghai. The price is rising because the metal is leaving. The squeeze is no longer theoretical. It's a logistical reality unfolding in real time. This is the story of the Friday raid. Let's dig into the specific numbers from the report. The biggest casualty of the day was Asahi Depository. Asahi is one of the major refiners and vault operators for COMEX. They're not some small regional player. Look at the column labeled adjustment. It shows a negative number, minus 1,269,200 ounces. This silver was moved out of the registered category. Registered means the silver is available for delivery against futures contracts. It's the inventory that backs the entire price mechanism. It's the metal that can actually be purchased. When silver moves out of registered, it either becomes eligible or it leaves the vault entirely. Either way, it's no longer for sale at the current price. This 1.2 million ounce removal at Asahi signals that a major commercial entity, likely a bank or a massive industrial user, took ownership of that metal and said, "This is mine, you cannot trade it anymore." They removed liquidity from the market. In a market that's already showing signs of tightness, removing over 1 million ounces of liquidity in one transaction is a shock to the system. It thins out the order book. It makes the next 1 million ounces more expensive to acquire. But that was just the adjustment. Look at the withdrawn column for Asahi. 596,715 ounces. This is metal that physically left the Asahi vault. It's not sitting there in a different category. It's gone. Combined, Asahi lost access to over 1.8 million ounces of liquidity in a single day. This is a hemorrhage, not a leak. It wasn't just Asahi either. The raid was coordinated across the entire vault network. Look at Brinks. Brinks is one of the most secure logistics companies in the world. They don't just guard museum paintings. On Friday, they saw withdrawals of 619,579 ounces. That's over 500,000 ounces loaded onto trucks and transported away from the depository system. Now examine CNT Depository. CNT is a major hub for government and industrial silver storage. They saw withdrawals of 601,775 ounces, and they saw another 543,000 ounces adjusted out of registered status. The pattern is consistent across every major facility. Do the math with me. 600,000 from Brinks, 600,000 from CNT, 600,000 from Asahi withdrawals. Add the withdrawals from Loomis, another 600,000 ounces. Include JP Morgan, 320,000 ounces. When you total the withdrawn column across all depositories, you arrive at roughly 2.7 million ounces removed in one day. On a Friday. Usually Fridays are quiet in the physical metals market. Usually metal moves slowly at the end of the week. But this volume of physical movement suggests something close to panic. It suggests that the owners of this metal wanted it out of the COMEX system before the weekend started. They did not want to leave it sitting in the vaults for another 48 hours. Why would they feel such urgency? Because they know what's happening in Shanghai. Now let's examine the bottom line of this report. The total registered silver in the COMEX system stands at 123,897,998 ounces. Some analysts will look at that number and say, see, there's plenty of silver. 123 million ounces is substantial. But you have to look at the rate of change, not just the absolute number. Earlier this week, that registered number was higher. On Friday alone, the total registered category dropped by 880,000 ounces. If we continue to burn through nearly 1 million ounces of registered silver per day, and if we continue to withdraw nearly 3 million ounces of total silver per day, how long does that stockpile actually last? It's not infinite, and crucially, not all of that 123 million ounces is actually for sale at $79. Much of it is what I call sticky. It's owned by banks who are using it to hedge their positions. It's held by institutions who need it for regulatory capital requirements. The free float, the metal that can actually be purchased by retail investors or industrial users, is likely a small fraction of that headline number. We're watching the available inventory shrink at the exact moment the price is breaking out. This is the classic setup for a supply crunch. Price goes up, inventory goes down. Basic economics says the situation cannot persist indefinitely. The price has to accelerate upward to stop the drain, or the drain continues until the system breaks. Let's correlate this vault data with price action. While those trucks were driving away from the depositories on Friday, the price of silver rallied $4.34. It closed at $79.91. This confirms that the paper market is detecting the physical tightness. Traders are bidding the price higher because they recognize the metal is leaving. They're searching for the market clearing price where the withdrawals finally stop. Is it $79? Apparently not, because the metal kept leaving even at that level. Is it $80? We're about to find out. The fact that we closed at $79.91, just 9 cents below that round number at 80, feels like psychological warfare. The market is pressing against the ceiling. It's testing resistance. With vault reports showing such massive outflows, the fundamental justification for breaking through $80 is now undeniable. This isn't speculation anymore. This is replacement cost reality. The people taking physical delivery of the metal know it's worth more than $79. That's precisely why they're taking it. So the metal is leaving New York. Where is it going? Physical silver doesn't disappear into a black hole. It has a destination. That destination is China. We need to analyze the Shanghai magnet. We need to look at the price differential. Silver closed the week in Shanghai at $83.36. We need to calculate the arbitrage spread. There's a $3.45 profit opportunity for anyone who can move metal from New York to Shanghai. This explains the withdrawals we're seeing. The metal is flowing downhill to the highest price, like water finding its level. And we need to understand why this arbitrage drain is impossible to stop. Unless the US price rises to match China, the vaults in New York will continue bleeding until the gap closes or until they're empty. We're watching the financial equivalent of hydraulics. The pressure differential is massive, and the current is flowing east. We're following the money trail. If you're just joining this analysis, we've established what happened. We audited the COMEX vaults. We documented 2.7 million ounces of physical silver leaving the warehouses of Asahi, Brinks, and CNT in a single day. We watched the registered inventory drop by nearly 1 million ounces. We saw the price surge to $79.91. But a forensic investigation isn't complete until you establish motive. Why is the metal leaving? And more importantly, where is it going? Silver bars don't just evaporate, they have to travel. And right now, all roads lead to one place, China. We're going to expose the Shanghai magnet. We're going to examine the closing price of silver on the Shanghai Gold Exchange this Friday. It closed at $83.36. We're going to calculate the arbitrage spread in detail. There's a massive locked-in profit available to anyone who can drain the US vaults and ship metal to Asia. And we're going to explain why this flow of metal is a one-way street. China has effectively locked the gates. The metal flows in, but it never comes back out. The West is being drained to feed the industrial requirements of the East. Let's follow the money. Look at the numbers with me. New York closed the week at $79.91. Shanghai closed the week at $83.36. Pull out your calculator. 83.36 minus 79.91 equals $3.45. This is the spread. This is the price differential. In the world of high-frequency trading and global commodities arbitrage, a spread of $3 is an eternity. Usually spreads between major exchanges are measured in pennies, maybe a dime or a quarter if there's temporary dislocation. A $3 gap means the market is fundamentally broken. It means the two exchanges are disconnected from each other. But for a physical trader, this means risk-free money. If you're a bullion bank like JP Morgan or a trading house like Glencore, you have a simple mandate. Buy low, sell high. You buy silver in New York for $79. You pay approximately 50 to 60 cents per ounce for shipping, insurance, and logistics to transport it to Shanghai. Your all-in cost basis is roughly $79.50. You sell it in Shanghai for $83.36. You make nearly $4 of profit on every single ounce. Now multiply that by the 2.7 million ounces that left the vault on Friday. That's over $10 million of locked-in profit generated in a single day of logistics operations. This is why the vaults are draining. It isn't a conspiracy, it isn't market manipulation, it's pure capitalism functioning exactly as designed. The metal flows to the highest bidder, and right now, China is the highest bidder by a significant margin. This arbitrage creates what I call a vacuum effect. The higher the price rises in Shanghai, the faster the metal leaves New York. It's self-reinforcing. And here's the critical problem for the COMEX short sellers. Shanghai is not slowing down. The industrial demand we've been tracking, solar panels, electric vehicles, battery technology, is pushing the Shanghai price higher every single day. This means the magnet is getting stronger, not weaker. If New York tries to suppress the price, if they attempt to keep silver at $75, the gap widens to $8. If the gap widens to $8, the profit margin for draining the vault doubles. This creates even stronger incentives for more traders to execute the arbitrage. More trucks show up at the loading docks. So the banks in New York are trapped in an impossible situation. They cannot keep the price artificially low anymore. If they keep it low, they lose all the physical metal. If they lose all the metal, the exchange faces potential default. So they have no choice but to raise the price. They have to chase Shanghai higher. This is why silver rallied $4 on Friday. It wasn't retail speculation. It wasn't momentum traders. It was defensive pricing. COMEX had to raise the bid to slow the bleeding, but even at $79, they're still $3 too cheap. The arbitrage window remains wide open. Now you might ask, why doesn't silver flow back in the opposite direction? If the price gets too high in China, won't arbitrageurs sell it back to the West? The answer is no, because of export restrictions. We covered China's new regulations in previous analysis, but it's critical to mention here. As of January 1st, China has severely restricted the export of silver. Only 44 state-approved firms have licenses to export, and they operate under strict quotas. This means the silver market has become what I call a roach motel. The metal checks in, but it doesn't check out. Once that bar of silver leaves the Brinks vault in New York and lands in Shanghai, it is gone from the Western financial system permanently. It enters the Chinese industrial stockpile. It will be manufactured into a solar panel. It will be stored in the People's Bank of China's strategic reserves. It will never again be available to settle a COMEX futures contract. This makes the drain permanent and irreversible. We are permanently reducing the float of investment-grade silver available in Western markets. Every single day this arbitrage exists is another day that the West transfers strategic assets to the East. We're trading real resources for temporary paper profits. This brings us to a deeper point about the difference between price and value. Price is what you pay. Value is what you receive. Right now, the West is obsessed with price. Traders say, oh, $79 is expensive, maybe I should sell and take profits. The East is focused on value. Chinese industrial planners say this metal is essential for our energy infrastructure, for our manufacturing base, for our economic future. We must secure it now before it becomes unavailable at any price. China understands that the true value of silver is higher than $83. That's why they're willing to pay the premium. They're not overpaying. They're securing a critical resource before supply runs out completely. They're front-running the rest of the world. When you look at that $83 price tag in Shanghai, don't interpret it as a bubble forming. Interpret it as the real price. That's what silver actually costs in a market where physical delivery is the absolute priority, where industrial users are competing against each other for limited supply. The COMEX price of $79 is the illusion. It's the price of a paper derivative contract, trying to pretend it represents real metal. But as the physical metal leaves the system, as the vaults empty out, that pretense is being exposed. The real price is dragging the fake price kicking and screaming toward higher levels. Eventually, they will converge. They will converge at the higher number, not the lower one. So the magnet is activated. The metal is flowing east. The arbitrage gap is wide open. But how much metal is actually left to drain? We need to examine the registered inventory again. The number on the spreadsheet says 123 million ounces. That sounds like a lot. It sounds like a fortress of supply. But we need to audit that fortress. We need to peel back the layers of the registered category. We need to ask the hard question, is all of that 123 million ounces actually available for purchase? Or is it a mirage? We need to calculate the burn rate. At 2.7 million ounces per day, how many days do we have left before this system faces a crisis? And we need to discuss the tipping point, the inventory level where panic actually starts. The vault is leaking. The leak is accelerating. Let's check the fuel gauge. We've watched the trucks leave the loading docks. 2.7 million ounces disappeared in one day. We've tracked the destination, Shanghai. The arbitrage gap is acting like a vacuum, sucking metal eastward. But now we have to examine what's left behind. If you look at the vault data, there's a number at the bottom. 123,897,998 ounces. This is the total registered silver inventory remaining in the COMEX system. To the casual observer, this looks reassuring. They think there's plenty of silver. Look at that number, 123 million ounces. That's nearly 4,000 tons. How can there be a squeeze with that much inventory? This is the most dangerous illusion in the market right now. It's a mirage. We're going to audit that number properly. We're going to apply the burn rate from the last 48 hours to that stockpile. We're going to demonstrate that at the current rate of depletion, the fortress will be functionally empty in weeks, not years. And we're going to examine the paper leverage, the millions of ounces worth of contracts that have claims on that shrinking pile of physical metal. The bank account looks full on paper, but the checks being written against it are starting to bounce. Let's do the math, cold and calculated. We start with 123 million ounces in registered inventory. On Friday alone, we witnessed 2.7 million ounces physically withdrawn from the system. We also saw approximately 1.5 million ounces removed from the registered category through adjustments. If we assume this withdrawal rate continues, if banks and industrial users keep draining 2 to 3 million ounces per day to feed the Shanghai arbitrage opportunity, how long does the silver last? Get your calculator ready. 123 million divided by 2.7 million. The answer is roughly 45 trading days. 45 days. That's approximately 9 weeks. That takes us to mid-March. Think carefully about the implications of that timeline. The global pricing mechanism for silver, the exchange that sets the benchmark price for everything from investment coins to industrial applications, has approximately 2 months of inventory left at the current depletion rate. This is not a long-term structural problem. This is an immediate crisis developing in real time. And here's what most people don't understand about markets. Markets do not wait until the last ounce has physically gone to panic. They panic when they see the trend line pointing toward zero. And right now, that trend line is pointing straight down with an increasingly steep angle. But it actually gets worse than that simple calculation suggests, because not all of that 123 million ounces is truly available for sale. This is what I call the sticky ounce theory. Who actually owns that metal sitting in registered status? It's not just one communal pile owned by the exchange. It's owned by individual institutions. JP Morgan has silver there. Citibank has silver there. Wells Fargo, HSBC, various bullion banks, they keep metal in the registered category to satisfy regulatory capital requirements, to hedge their short positions in the futures market, to provide collateral for other derivative positions. These banks do not want to sell that metal. They're being forced to part with it by the mechanics of the futures market. As inventory drops to critical levels, as we approach perhaps 80 million ounces or 60 million ounces, these institutions will start hoarding aggressively. When the stockpile hits a certain threshold, JP Morgan will say, that's enough, we're done, no more deliveries. They'll convert their metal from registered to eligible status. They'll effectively lock their vault doors. So the actual free float, the amount of silver that can truly be purchased before institutions stop the bleeding, is likely much smaller than 123 million ounces. It might only be 50 million ounces. It could be as low as 20 million ounces of genuinely available supply. We don't know exactly where that red line exists, but we know with certainty that we're sprinting toward it at an accelerating pace. Now let's examine the other side of the balance sheet. The demand side, the open interest. This represents the number of paper contracts currently active in the COMEX silver futures market. According to the latest data, there are roughly 140,000 open contracts. Each individual contract represents 5,000 ounces of silver. 140,000 contracts times 5,000 ounces equals 700 million ounces of paper silver claims. Now compare those two numbers directly. Paper claims total 700 million ounces. Physical metal available is 123 million ounces. The ratio is nearly 6 to 1. For every single ounce of actual silver sitting in the vault, there are 6 different parties who believe they have a claim to ownership. In a normal functioning market, this fractional reserve system works adequately. 5 of those 6 claimants will accept cash settlement instead of physical delivery. They're just speculating on price direction. They don't actually want the metal, but we're not in a normal market anymore. We're in a world where Shanghai is paying a $3.45 premium. We're in an environment where there's nearly $4 of risk-free profit available by taking delivery and shipping to China. In this environment, those 6 claimants don't want cash. They want the physical bars. They want to take delivery and execute the arbitrage trade. If just 20% of contract holders decide to stand for physical delivery, that represents 140 million ounces of demand. The vault only contains 123 million ounces. The math doesn't work. The exchange would default. Game over. This is what I call the leverage bomb sitting at the heart of the paper silver market. The banks have sold more tickets than there are actual seats on the airplane, and now everyone is trying to board at the same time. The gate agents are starting to panic. There's an old saying in economics, burning the furniture to heat the house. It means you're consuming your capital assets, your productive resources, just to survive the immediate crisis. Eventually, you run out of chairs and tables, and then you freeze to death. That's exactly what the Western financial system is doing right now with silver. By allowing this inventory to drain, by permitting JP Morgan and the arbitrage traders to strip the vaults, they're keeping the paper price artificially suppressed for one more day, one more week. They're selling off the strategic reserve to maintain the illusion of control. They're burning the furniture to keep the house warm temporarily. But eventually you run out of furniture. Then what? The Asahi withdrawal of over 1 million ounces on Friday was a chair being thrown into the fireplace. The Brinks withdrawal was a table. The CNT withdrawal was a bookshelf. We're witnessing the liquidation of the West's tangible wealth in real time, and it's being purchased by the East for what will eventually be recognized as pennies on the dollar. So the math is fundamentally broken. The leverage is toxic. The clock is ticking down, and the price closed Friday at $79.91, 9 cents away from 80. What happens Sunday night when trading resumes? What happens when Asian markets digest this inventory report over the weekend? They're going to recognize that the West is bleeding. They're going to smell blood in the water like sharks circling wounded prey. We need to examine what I'm calling the Monday gap. We need to explain why the $80 level is likely to be breached in the opening minutes of trading. We need to provide a strategic framework for next week's price action. And we need to deliver the final verdict on this run on the COMEX system. The vault is leaking, the sharks are circling, and the price is about to explode higher. We're preparing for the breakout. We've reached the final chapter of this forensic investigation. We've documented the 2.7 million ounces that vanished from vaults on Friday. We've traced the arbitrage pathway to Shanghai, where silver trades $3.45 higher. We've calculated the burn rate that could empty the available inventory in 45 trading days or less. Now we're left staring at one number, $79.91. That's where the market closed. We are exactly 9 cents away from the $80 psychological barrier. 9 cents. Do you think that's coincidental? Absolutely not. The market is coiled like a compressed spring. It's pressing upward against resistance, gathering energy, waiting for the opening bell Sunday night. The banks attempted to hold price below 80 to save face for the weekend, to avoid the headlines that would come with an $80 close. But they failed to stop the physical drain. The metal kept leaving despite their efforts. We're going to lay out the Monday morning battle plan. We're going to explain why we are mathematically set up for a gap opening above $80 when electronic markets restart. We're going to discuss how to handle the psychological impact of seeing silver trade with an 8 handle. And we're going to deliver the final assessment of this run on the COMEX system. The vault door is open, the metal is leaving, and the price is about to chase it higher. Let's finish this analysis. What happens when Asian institutional traders see this inventory report? It's Saturday now. The news is spreading through trading desks in Shanghai, Tokyo, Hong Kong, Singapore. COMEX loses 3 million ounces. Major vaults raided. Registered inventory dropping. When the Globex electronic market opens Sunday evening, traders in those time zones will react immediately. They understand what it means when the West runs out of metal. They recognize the arbitrage window is closing, not because the spread is narrowing, but because COMEX is running out of inventory to arbitrage. If they want to secure physical supply, they need to act now, before the well runs completely dry. So they will buy aggressively from the opening bell. I'm expecting to see a gap up opening. The price will likely jump over $80 in the first few minutes of the session. It might open at $80.50. It could open at $81. This gap creates immediate consequences for market structure. It leaves short sellers who are defending the $79 to $80 zone suddenly trapped underwater with no easy exit. They're caught on the wrong side of the move. To close their positions, they have to buy, which means pushing prices even higher. This creates a feedback loop. The gap transforms that $79.91 close into the new support level. What was resistance becomes support. The ceiling becomes the floor. And once we break decisively through $80, we enter what technical analysts call blue sky territory. These are price levels with no historical resistance above them, no overhead supply, no memory of previous trading ranges. The only constraint becomes the next round number, the next psychological level. Why does crossing $80 matter so much? It's just an arbitrary round number, correct? To an algorithm, yes, it's meaningless. But to human psychology, it's a massive milestone. When silver hits $80, it sends a signal to the broader financial world that this situation is escalating beyond normal market dynamics. It generates headlines. Silver breaks 80 on supply crisis. Silver hits 40-year high. These headlines capture attention from investors who weren't paying attention at $70 or even $75. This brings in momentum chasers, the capital that follows trends rather than creates them. These traders didn't care about silver when it was consolidating, but now that it's moving violently, they want exposure. They want to be part of the action. This new wave of capital hits a market that has virtually no available inventory. The dealers are already sold out of retail products. The vaults are draining at record speed, so these new buyers have to bid the price up to induce existing holders to sell. But who's going to sell physical silver at $80? Are you going to sell? No. Are the miners going to sell? No, they're holding production for higher prices. Are the Chinese going to sell? Absolutely not. They're buying more. So the price has to climb to 85, then 90, searching for the pain point where current holders are finally willing to part with metal. And right now, based on the behavior we're seeing, nobody's willing to let go. Supply is locked up. So what's your strategic framework for next week? First, watch the vault reports obsessively. Ignore the intraday price noise. Ignore the $1 or $2 swings that will inevitably happen. Every single day, around 2 to 3 p.m. Eastern Time, check the CME inventory report. Ask yourself the critical questions. Is the metal still leaving the system? Is the registered number continuing to drop? Is withdrawal activity accelerating or decelerating? As long as the answer to those questions remains yes, the metal is still leaving, then the bull market thesis stays intact. The price must rise to stop the drain. That's not speculation, that's economic law. Physical supply and demand must eventually find equilibrium, and right now equilibrium is far above current prices. Second, do not sell prematurely out of fear. We are in what's called the acceleration phase of a bull market. This is not the time to be taking profits on small moves. The drain is speeding up, not slowing down. If you sell now because you think it's gone up too much, you're giving away scarce physical assets right before the supply crisis intensifies. You're trading real metal for fiat currency that's being printed into oblivion by central banks. Third, prepare yourself psychologically for increased volatility. As we cross through $80 and move into the 80s, the price swings will get bigger in both directions. We might see a $5 drop on Tuesday that makes your stomach turn. Do not panic when you see that. Look immediately at the inventory data. If metal is still leaving COMEX while the price drops, that price drop is artificial. It's paper market manipulation disconnected from physical reality. It's a gift for anyone who wants to add positions at temporarily lower prices. Trust the metal movement, not the screen price. So here's my final verdict on the 2.7 million ounce raid we documented. This event was the signal many of us have been waiting years to see. It proves conclusively that the largest players in the market, the whales, the institutions, are no longer content to trade paper derivatives. They want the physical bars. They're taking delivery. They're removing the collateral from the fractional reserve banking system. This is a vote of no confidence in fiat currency and sovereign debt. JP Morgan voted with their actions on Friday. They withdrew 320,000 ounces. They're not bearish on precious metals. They're securing physical inventory while it's still available at remotely reasonable prices. Asahi's clients extracted nearly 2 million ounces through withdrawals and adjustments. They're not waiting around for better entry points or dip buying opportunities. They're acting with extreme urgency. These are the sophisticated players, the institutions with unlimited resources, with access to the best information, with decades of market experience. They are moving physical metal out of the public system as fast as logistics will allow. What do they know that the average retail investor doesn't understand yet? They know that when fractional reserve systems finally break, they break suddenly and catastrophically. They know that inventory trend lines pointing toward zero accelerate faster than anyone expects. They know that the exact moment COMEX cannot deliver physical metal against futures contracts, the paper price becomes completely irrelevant and meaningless. They're positioning for that moment right now, today. You should be doing the same thing. The vault doors are wide open. The metal is pouring out. The price is beginning to chase it higher. Monday morning is coming in less than 48 hours. The $80 barrier is coming. It's not a question of if, it's a question of when. And the supply crisis that precious metals analysts have been warning about for the past decade, it's no longer a theoretical future possibility. It's happening right now. It's here. The run on the COMEX bank has officially started. The lines are forming. But you're already inside the vault if you hold physical metal. You already have possession. Now just hold your position. Don't get shaken out by volatility. Don't let paper price manipulation separate you from real assets. Monday is coming. $80 is coming. And those vaults are getting emptier with each passing day. If this breakdown helped you understand what's really unfolding behind the price movements, subscribe to Boring Currency. We're tracking vault reports daily, we're following the institutional money flows, and we're documenting the unraveling of the paper silver market in real time as it happens. The metal is moving. Make sure you're positioned correctly.